Good morning, everybody. My name is Adrian Bailey, and I'm one of the principals of Cleary Hore, and I'd like to welcome you to our webinar today, where Kate Chalker will be taking us through the topic property development, revenue or capital. Very topical area to discuss, and clearly many of you will have clients who have either deliberately or perhaps seen an opportunity and completed a property development, whether it's the standard splitting a block and building some duplexes, or whether it's something more complicated. And of course, the question that always arises is this: the receipts on the return of the development, are they going to be on revenue account or capital account? Certainly a hot area as well for the tax office, and we're currently assisting a few clients with queries and audits from the tax office in this world, where unsurprisingly, the tax office are usually taking the view that it's on revenue account as opposed to capital account. Before I introduce Kate, just a couple of housekeeping issues for you. You should be able, on the right-hand side of your screen, there should be a couple of options there, one of which is the Files button. If you click on that, that'll give you the ability to download the slides from today. If you forget to do that, we will be sending them to you on an email after the webinar. So if you don't get a chance to download the slides during the presentation, they will be available on that email as well for download. If you have questions during the presentation, you will also see a chat box. Just type your question into the chat, and I'll be staying on the line to moderate those, and I'll interrupt Kate at an appropriate time and ask her that question. So feel free. We'll also have time at the end for questions, but what we find usually is it works a bit better if you have a question, fire it in, and I'll ask Kate of it while we're in that area. We're just finishing up on that area and it's fresh in everyone's mind. We're also going to be running a couple of polls during the session today. These polls, there will be some serious ones during Kate's presentation. And of course, there's no wrong answers in them. You'll be given the option, just want to get your thoughts on a couple of things. And there's a not so serious one to start off with. It's been a while. I'm trying to work out in my head. I think it's over 12 years since Cleary Hore as a firm participated in Movember. And for those that don't know, Movember is a charity which assists with men's mental health. And during the month of November, the challenge is to grow a mustache, hence the name Movember. So our first poll, which we're going to start now and close off a bit later, is whether you think Cleary Hore as a firm should participate in Movember. So a nice easy poll there, yes and no. In terms of the presentation today, as I mentioned, Kate Chalker will be presenting. Kate works in the Sydney office. She has a lot of experience in this area in terms of both assisting clients with property development matters, as well as in giving advice, and then at the other end, helping out with audits where clients are unfortunate enough to have some questions from the ATO about the returns on their property development. Kate's senior solicitor with the firm. She's currently studying her Masters of Tax, and I know a few in the audience are also studying Masters of Tax with Kate at the moment. So I'd like to introduce Kate to kick things off.
Thanks, Adrian, and good afternoon or good morning, everyone, depending on where you are. As Adrian mentioned, today's webinar will be looking at the contemporary issue of property development and looking at the different ways in which the proceeds can be treated from a taxation perspective. Obviously, the property development industry is booming right across the country at the moment, and there's a lot of money at stake when it comes to these developments. So it's really important that we, as advisors, are able to identify the key tax issues and risks that could arise during the development stage, and also to advise our clients on the likely way in which the ATO will treat the receipts upon sale. So in terms of an agenda for today's webinar, firstly, I'll take you through essentially what the law is on this area, and I'll go through the three different ways in which the sale proceeds can be treated from a tax perspective. One of which is to be treated on capital account, and there's two other ways in which they can be treated on revenue account, with a few variations between the two. From there, I've extracted some of the facts and circumstances from 3 real-life case studies, and For a bit of audience participation to see whether you're all paying attention today, we will be running some polls for those questions to get your opinion on how you think the proceeds would be treated in those situations. And then from there, we'll move to the more practical part of the webinar to consider if there's any particular strategies or structures which can be implemented throughout the development phase to maximize the potential tax outcome for our clients. So as I mentioned, there are 3 possible ways in which the proceeds can be treated in the hands of the landowner. 1 on capital and 2 on revenue account. So when it's being treated on capital account, that's when the ATO or the commissioner determines that the sale is the mere realization of a capital asset. And that's really the ideal outcome that we want to achieve. The next possible outcome is where the proceeds are treated on revenue account because the ATO has considered the landowner to be carrying on a commercial transaction or a profit-making undertaking. You may have heard of isolated business transactions. That would fall into that second outcome. The third outcome is where the ATO or the commissioner determines the landowner to actually be carrying on a business of property development. And in that situation, the properties would be converted to trading stock and the proceeds would be assessed on revenue account. So I'll take you through the 3 of those outcomes in a bit more detail now. So the first and the ideal outcome is to have the proceeds treated on capital account. And as I mentioned, that will occur when it's seen to be the mere realization of a capital asset. So this won't apply if the commissioner deems you to have a profit-making intention, to be selling the property with an intention of making a gain. And it won't occur if the commissioner sees the landowner carrying on a property development business. It's simply where the landowner is holding a capital asset and they decide to realize it by selling it to the best advantage of the land. So if you've got a client who's held a property for a substantial period of time, they've been holding the property for personal activities or even holding it as an investment property for the purpose of deriving rent. If we can show that they're not selling that property for the purpose of making a profit or gain, then the argument could be made that the proceeds should be treated on capital account. If the commissioner is happy with that approach, then the outcome is that the proceeds won't be treated as ordinary income. Rather, it will be treated as the disposal of a CGT asset. So it will trigger CGT event A1, disposal of an asset, and from there, the normal CGT provisions will apply. And so the real benefit with achieving this outcome is that if the taxpayer is an individual or a trust and they've held the property for at least 12 months, they will get the benefit of the 50% CGT discount, which will effectively halve their tax bill on the sale of the property. So where did this concept of mere realization come from? Just to give you a bit of background, it actually came from a fairly old case from 1950 called Scottish Australian Mining Co Limited and the Commissioner of Taxation. So in this case, the taxpayer was a company that was carrying on a business of mining coal. And the company went and purchased a block of land for the purpose of carrying on that business. Eventually, the taxpayer decided to subdivide the land. The company went and built roads and a railway station on the property, made sites available for schools, churches, and parks, and eventually the company sold the subdivided lots for a substantial profit. Interestingly enough, the court in this case found that the profits were not assessable income. This was still the mere realization of a capital asset. And the court found that the company had merely taken the necessary steps to realize the land to the best advantage. So that was a favorable outcome for the company. but unfortunately, this case really has been overruled by some later cases which came up in the 1980s, and the tax position in relation to mere realizations really has changed. So in this case, the court looked at the intention when the property was purchased, and the intention then was to conduct the mining business. But the way in which the law has gone is that now there can be a later change in intention which can convert the property from a capital asset to an income asset. So, and I'll touch on those cases a little bit later in this presentation. But just by way of background, that's where the concept of mere realization came from. So importantly, as I just mentioned, even if you're realizing a capital asset and you didn't have a purpose of profit making at the time of purchase, it can still become ordinary income if it goes beyond the mere realization of a capital asset and instead turns into a business operation or a commercial transaction. So being held on capital account is the ideal outcome, but we need to be really careful to make sure we're not verging into those second two outcomes. So the second outcome is where the proceeds will be treated on revenue account, but it won't go so far as to trigger the trading stock provisions. So this outcome will apply where there is a profit-making scheme or a profit-making undertaking, but the development works don't go so far as to constitute the carrying on of a business. And so this will be triggered if the taxpayer had a profit-making intention either when the property was purchased or, like I said, in the 1980 developments, if it did have that profit-making intention when they decided to engage in the development and sell the properties for a profit. And some of you may have heard of the concept of isolated transactions, and there were two landmark cases in the 80s, namely Maya Emporium and Whitford's Beach, which really developed this concept and, like I said, really changed the perspective of the law from the perspective of property developments. So the first case which I'll touch on is Maya Emporium, a 1987 case. And this case didn't actually have anything to do with property developments, but it really shaped the area of the law when it comes to isolated transactions. So in this case, the company, Maya Emporium, it decided to make an interest-bearing loan to a subsidiary. And then 3 days later, as had always been the intention of the company, it decided to assign the right to receive interest income from the loan in return for the payment of a lump sum. And the High Court held that the lump sum payment which it had received was actually ordinary income. And the reasoning for that was, even though that type of transaction wasn't within the ordinary course of the taxpayer's business, we're talking about Maya here, it's a retail operator, its normal business is to make sales through retail. The court held, even though it wasn't within the course of that business, it was entered into with the purpose of making a profit, and therefore the amount of the lump sum payment could be treated as ordinary income. So that case really shows that if you've just got an isolated transaction, it can be treated as ordinary income in the hands of the taxpayer. The other landmark case was Whitford's Beach, which was determined in 1982. So in this case, we had Whitford's Beach acquire a very large parcel of land. It was 1,584 acres worth of land, and it purchased that block for non-commercial purposes. But sometime later, the original shareholders of the company decided to sell all of their shares. There were new shareholders brought in, and they decided to vary the articles of the company and to embark on quite an involved and complex property development. And so from there, the company went and rezoned the property to residential and went and subdivided the property into 2,200 lots. So quite a large and involved development. And over the years, those lots were sold for, as you can expect, a substantial profit for Whitford's Beach. In this case, the High Court held that this was definitely more than the mere realisation of a capital asset, and it actually constituted the carrying on of a business of subdividing and selling land. So this case would actually fit into the third outcome, the carrying on of a business, but this really is the landmark case when it comes to profit-making undertakings and isolated transactions, because there's a lot of important remarks made in the judgment which set out that even if you purchase the property, like in this case, not intending to develop it and sell it for a profit, there can be that later change in intention, which will convert the property from a capital asset to an asset which should be treated as ordinary income. And so really the first question which we need to determine when we're advising our clients is, will the proceeds be treated as revenue or capital? And so it's not really black and white, as you can tell. There's quite a lot of grey area. And so in 2018, the ATO did publish a draft property and construction website guidance. It's since been withdrawn for consultation, but this was quite a comprehensive publication which came out, which set out a number of different indicia or factors which will be considered by the ATO when determining whether the property is held on capital or revenue account. So I'll take you through some of those different indicia. Remembering that, of course, the list is non-exhaustive, so there could be other factors taken into account by the ATO. But the first one listed there was whether the landowner has held the land for a considerable period prior to the development and sale. If the landowner has held the land for a while before deciding to develop it, that's more likely that it will be treated as capital. Because if you think of property developers, if they are carrying on that business, they will look to purchase the land and straight away they'll be moving towards DAs and construction and looking to sell those properties as soon as possible. So if you are holding on to the land, living in it, renting it out, whatever it might be, and holding on to it for a while, that will look more like a capital transaction than income. Similarly, if the landowner is conducting farming or other non-development business activities on the land before they decide to develop and sell it, that will again look more like a capital transaction. Because again, if you've got the big property developers buying a property, they're not going to be starting a farming operation or doing anything else with the land. They're just going to be looking to develop it and sell it for a profit straight away. The third indicia listed in this guidance was whether the landowner originally bought the property as an investment, such as for long-term capital appreciation or to derive rental income. If that factor is present, that again will lean more towards capital than income. The fourth one is where the property has recently been rezoned and whether the landowner actively sought rezoning. If the landowner is actively seeking a rezoning of the property, that's more than likely going to be income because they're taking those steps to try and change the nature of the property, to develop it, and more than likely to sell it for a profit. So if they are taking those active steps, that will tend more towards income than capital. The next one is where a potential buyer has made an offer to the landowner before they enter into a development arrangement. If the landowner did receive a genuine, reasonable offer on the property and they turned it down, only to then go and commence a development activity, that's going to look like income. because if they were just realizing the capital asset, they probably would have just taken that genuine offer and not bothered with the development activity. But that's looking more like a profit-making undertaking or even the carrying on of a business. The next one is where the landowner applies for rezoning and planning approvals around the time or sometime after acquiring the property, but before undertaking further steps that might lead to a profitable sale or entering into development arrangements. Again, it's taking those further steps and really doing whatever is needed to maximize the profit on the sale, which would tend more towards income than capital. And then we also have the landowner registering for GST on the basis that they are carrying on an enterprise in relation to developing the land. That will look more like income than capital if they themselves are saying, yes, we're carrying on an enterprise by developing the land. And then these are our last three. So we have whether the landowner and the developer are related entities. If they're related entities, it's probably going to be more capital than income in that they're not going out and finding a professional developer and going into the arrangement that way. Next one is the level of financial risk borne by the landowner and the level of control that they exert over the development. So the more financial risk that they have and the more control that they exert over the development, the more likely it will be income than capital. Really, we want the landowner to be as passive as possible, not to have the risk, not to have the control over the operations if we do want to maintain that capital treatment. And then finally, if the landowner has a history of buying and profitably selling developed land or land for development, the ATO will more than likely use that against you to say that you've got a history, this is a repetitive activity, this is definitely for a profit-making intention, and it will be treated on income account. So those are the types of factors or indicia that we should be looking at to consider whether the proceeds will be treated as capital or as income. And if we form the opinion that this is probably going to be treated on income account, we then need to determine, is this going to fit into the second outcome, not trading stock, or the third outcome, where the properties will be converted to trading stock. And so in order to fit into this third outcome, what the Commissioner needs to show is that the taxpayer is actually carrying on a business of developing property. So it's where the revenue purpose amounts to a business activity and it goes beyond just a one-off profit-making undertaking or a commercial operation. And so where that is the case, then the trading stock provisions will be triggered, excuse me, because the definition of trading stock is defined to include anything produced, manufactured, or acquired that is held for purposes of sale in the ordinary course of a business. So if the properties are found to be developed in the course of a business, then they will become trading stock of the landowner. And so now we need to consider the age-old question of, is the landowner actually carrying on a business? Again, it's difficult to determine, it's not black and white, and so we need to consider the different factors to determine, is this a business or not? And so in looking at that, there is a helpful taxation ruling which has been published. It actually looks at whether a taxpayer is carrying on a primary production business or not. But the different factors that are outlined in that ruling are very much relevant and useful to determining whether a property development business would be carried on. So,
sorry, before we get into the ruling, just a question, do all revenue transactions attract GST, trading stock or otherwise one-off?
Well, it would, in order to attract GST, there would need to be a taxable supply. So there would need to be new residential premises, or it would need to be land able to be used for residential land. And they also need to be carrying on an enterprise. And that's defined very broadly within the legislation. So if it is new residential land, it's more than likely going to attract GST, but I will touch on that briefly a bit later in the webinar.
Okay, thanks, Kate. That's all for now.
Thanks. All right, so getting back to the different indicators of carrying on a business, we would need to look at whether the activity has a significant commercial purpose or character. We need to look at whether the taxpayer has more than just an intention to engage in business. So you can't just be daydreaming of carrying on the business. You have to actually be taking physical steps to have that business operational. Then we need to look at whether the taxpayer has a purpose of profit as well as a prospect of profit. So again, all well and good that you intend to make a profit, but is that actually feasible? Are these properties actually going to sell for a good price to enable the landowner to recoup their costs and make a profit on the sale? And then another one, is there repetition and regularity of the activity? If you've got a history of buying land, developing properties, and selling them for a profit, that will definitely constitute the carrying on of a business. Then we have whether the activity is of the same kind and carried on in a similar manner to that of the ordinary trade in that line of business. So that's looking at what is this landowner doing compared to the big property developers in the industry? Are they carrying on the business in the same kind of way, or is it very different? Then we need to look at whether the activity is planned, organised, and carried on in a business-like manner that is directed at making a profit. So that's things like, do we have a business plan? Do we have strategies and steps in place to make sure that the development can realise a profit? Then we have the size, scale, and permanency of the activity. That's really what got Whitford's Beach, was just the fact that there were so many different lots being sold. It was of such a size and scale that it couldn't not be a business. And then lastly, if we don't have those indicators, it's probably going to be described as a hobby, a form of recreation, or a sporting activity. So if we are looking like it's going to be treated on income account, those are the different types of indicators that we need to look at to see, is this going to be a business? Is this going to trigger the trading stock provisions? If we think that it is, this is what will happen in relation to trading stock. So there will be a deemed CGT event K4, which will arise, and the timing of that CGT event will be when there is that change of intention, when that intention to hold the asset as trading stock does arise. And so at the time of that CGT event, the landowner will then have the choice to decide whether the deemed proceeds will be the market value at the time of the event, or whether they will be the cost of the asset. Often it will be the market value, but it really depends on how far along the development is as to which one is more. But that's what would happen if it was found to be carrying on a property development business. It would be treated as ordinary income, and the lots would be converted to trading stock. So now that I've taken you through the law as it applies to this area, I thought it would be useful if we could go through some case studies to see how those different principles would be applied. So as I mentioned, I'll take you through the facts of these case studies, and then there will be a poll for you to vote on whether you think it should be treated as income or capital. So the facts of this first case study: we had a company which was engaged in the business of building flats and selling them. So the company went and purchased 5 acres of land. And in this case, the governing director of the company gave evidence to say that when they purchased the land, what they were going to do was to build flats on the property and to retain them for renting out. So it was to make rental income. And he also gave evidence to say that a caretaker's residence was going to be built on the land and that he and his wife would live on that property. However, when they were trying to build those flats, there were some issues which arose, which meant that they had to abandon the project. And so 3 years after purchase, the company went and sold the land. It was undeveloped, but it still sold for a reasonable profit. So hopefully that poll has come up now, but the question for you is, how do you think the sale proceeds would be treated in the hands of the company? Do you think this is the mere realization of a capital asset and treated on capital account? Do you think it is a one-off profit-making undertaking treated on revenue account? Or do you think this is actually the carrying on of a business and again treated as assessable income? So I'll give you all a moment to have a think about it and to input your answers into the poll.
What's happening, Kate? We've just got a couple of questions that have come through. One's a bit of more of a comment, I guess you said. So if it's too weak for a business in terms of the analysis of the situation, it could still be a profit-making scheme, e.g. a one-off, as in the AAT case earlier this year. Yeah,
yes, that's correct.
Another question is, can you elect to have a deemed CGT disposal where the property is ventured into an isolated transaction?
You could elect to do that if you want. I'll come to this a bit later, but one of the strategies that some people have used is to sell the property right up front to a development entity so that you know that that has to be treated as capital, and then that development entity will incur the income upon the eventual sale. So I suppose that could be achieved, but I'll come to a different suggestion later on.
No more questions at the moment. I've just closed off the poll and the results. You should be able to see there if you want to.
All right. Thanks, Adrian. So the winner in this one, we've got on capital account as the mere realization of a capital asset. We had 43% of people vote for that one. The next one we had was on revenue account in the ordinary course of business. That's 32% of votes. And then we had the remaining 23% of people vote for revenue account as a profit-making undertaking. So the decision in this case was actually on revenue account in the ordinary course of business. So really what made the taxpayer fall down in this one was the fact that they were already carrying on a property development business. So it didn't really matter that their intention to keep the flats and rent them out didn't proceed. The decision was that because their ordinary course of business was to buy flats, develop them, and sell them for a profit, it was found that this was very much in the same course of that business, in that they had built the land and sold it off for a profit. And so the eventual sale proceeds were treated as a business receipt, accessible as ordinary income. And that's very much, as I said, on account of just the nature of the business they were carrying on. So the next case study we have a husband and wife that acquired a property with the intention of establishing a tropical fruit plantation. So over the next 14 years, husband and wife did a lot of work on the property. They planted 700 trees, and they spent over $200,000 on equipment and improvements. Eventually, the husband lost his job. He had a job separate to working on the plantation, and for financial reasons, they weren't able to continue developing the plantation. So husband and wife went and applied for the property to be rezoned as residential. and then it was subdivided at a cost, a very high cost actually, of about $724,000. And so then the husband and wife went and sold the subdivided blocks, and the gross sales amounted to just under $2 million. So I've got the same question for you again. How should the gross sales of $2 million be treated in the hands of the husband and wife? Will it be on capital account? Will it be on revenue account as a isolated transaction? Or will it be on revenue account as the carrying on of a business?
Just closed off that poll, okay?
Thanks, Adrian. So results of that poll, we had 58% of people voting that it was on capital account, and then we had 41% of people voting for revenue account as a profit-making undertaking. No one voted for the ordinary course of business. And so the 58% of you that said it should be treated on capital account, that is in accordance with what the AAT decided in this case. So the tribunal found that the husband and wife, they didn't acquire the property for the purpose of resale for profit. All they had done was realize a capital asset. So the tribunal looked at the scenario and thought, this isn't a business operation, this isn't a commercial transaction. All the husband and wife did was take steps to realize the land to its best advantage. So fortunately for the husband and wife, it was treated on capital account, and presumably they were able to apply the 50% discount to that gain. So that was a good outcome for them. Now we have our third and final case study. So in this case, we had a company which purchased a block of land. It had a motel on it. They bought that at auction. And then subsequently, the company realized that the block of land was actually a bit bigger than they had anticipated. So the block of land was actually 100 feet longer than what had been advertised in the sales brochure. So the company wasn't sure what to do with that extra bit of land, but eventually they decided to draw up some plans to build 4 shops on that extra part of the land. So those plans eventually got approved by the council. And then 3 years after the property had been purchased, the shops had all been built, they were completed and sold for a substantial profit in the hands of the company. So again, I'll leave you all just for a moment to put your answers in. Same question, how do you think the sale proceeds for the shops would be treated?
And I've just closed off that poll too, Kat.
Thanks, Adrian. So overwhelmingly, people have voted for revenue account as a profit-making undertaking. So it looks as though people have been paying attention because, again, that is the correct answer as determined by the court. So in this case, it was Justice Windia who decided that the profits were accessible as a profit-making undertaking or a one-off commercial venture. So the court here looked at the situation and thought that the building of the shops and the ultimate sale of them amounted to more than just the realization of a capital asset. And so there was a program or plan of action which amounted to a profit-making undertaking. It wasn't seen as enough to be a property development business, but it was seen to have a profit-making intention, and so the proceeds were assessed as ordinary income. So well done, everyone, and thank you for your participation in those questions. Much appreciated. So now that we've looked at the law and we've looked at some case studies and how they apply, now we'll move to the more practical aspect of today, which is really what can we do to prevent the ATO from treating these proceeds as income. And so when we have clients come to us and tell us that they want to embark on a property development, what are they trying to achieve? Normally, they really want these 4 things to happen. They want to ensure that their liability is limited, because clearly there's a fair amount of risk in the property development industry. There's financial risk, there's risks of people getting injured during the construction, and so they want to make sure that they and their assets are protected against that risk. If possible, they also want to try and have some flexibility in distributing the profit from the development. And then finally, what we've been talking about is wanting to retain the capital nature of the property or the land, because where possible, the commissioner will try to treat these developments as income, whether it's a one-off transaction or carrying on a business. So we need to look to do something to try and retain the capital nature and to maximise the capital component where we can. So after Whitford's Beach, and when people saw that there was this risk of properties being converted from capital to income, this is the type of structure that some people tried to implement. And this goes back to John's question a bit earlier. So what they would do is they would have the landowner, just before embarking into the development, they would have the landowner set up a new entity, whether that's a company or a trust, and then the landowner would sell the property to the developer. And then from there, the developer would go ahead, conduct the development activity, and finally sell the developed lots to the customer. And the reason why people did that was that they wanted to ensure that at the landowner level, the capital nature was preserved. So it would be very difficult for the commissioner to argue that in selling the property to the developer without having actually done any work to the property, it would be hard for him to argue that that was an income transaction. So they would sell that property straight up to make sure that it was capital in their hands and that they were able to apply the 50% CGT discount. Of course, the issue with this approach is that in that initial sale, there would have been stamp duty payable by the developer. So that's really the tax drawback in terms of that structuring. Once the property did end up in the hands of the developer, then it would be either treated as income or capital gain when it's eventually sold to the customer. And as we've gone through earlier, it will be treated as income if one of these 3 elements is present. If the property was acquired with a view to profit, if the eventual sale was entered into with a view to profit, or if the developer entity is viewed as carrying on a business. And so it's fairly likely that in that sale from the developer to the customer, it would tick one of those boxes and it would be treated as income. But people did like to implement that structure just to make sure that on that first part, on that first sale, that it was treated as a CGT event and not assessable income. However, a different strategy, a different...
Sorry, Kat, just before we get into the different strategy, just a couple of questions, if I may. Question, for a one-off transaction profit intention making, is it based on your initial intentions or can your intentions change over time?
Yeah, that's one where your intention can change over time. So even if you purchase it not intending to make a profit on sale, there can be a later change in intention and that can make it a profit-making undertaking and subject to income.
Yeah. And I think this is a comment in relation to the strategy that you were just discussing, which is that you can't get much value into the hands of the landowner. Yeah, it's limited to whatever the value is of the land at that time. Question for you on GST. Taxpayers registered for GST as they collect commercial rents. They've also held an investment residential property for 40 years, wants to build a duplex on site and hold to collect rents. Is building the duplex an enterprise and therefore can they claim the input tax credits, or not an enterprise and can't claim the input tax credits on the development?
I would say it probably will fall into an enterprise just because it is defined so broadly within the legislation. I think it's probably a safer view that it is considered an enterprise for GST purposes.
Yeah. Thanks, Kate. That's all for now.
Thanks, Adrian. So the other strategy, as opposed to just selling the property straight up to the developer entity, would be to form an unincorporated joint venture. And so importantly, this is not a partnership. It's not a separate entity at law. It's just a relationship between the landowner and the development trust, where they enter into this agreement or this arrangement to develop the property and sell it. And so the rights and obligations of each of the parties would be determined under a joint venture agreement. And so this is the type of structure which would be implemented under an unincorporated joint venture. So the client would set up a new trust on the left-hand side, a development trust. It could be controlled by them. And then the other party to the joint venture would be the landowner itself. And so those two parties would enter into a joint venture agreement where we would have the developer as the active party and the landowner as the passive party to the development. And it's really important when drafting this agreement to ensure that it can't be construed as a partnership, because there can be some negative tax consequences which would arise on it being a partnership. And really the main determining factor as to whether we have a joint venture or a partnership is whether the parties are taking out a proportion of the gross receipts or the net profit. If they are taking a share of the net profit, that will be a partnership. What we want is for the parties to take a share of the gross receipts from the development. If the agreement is not drafted properly and it does give rise to a partnership in the eyes of the law, the issue is that that would be a new entity, and so the partnership would need to lodge a separate tax return. And then the landowner would automatically be seen to be actively involved in the development, again, because it is a separate entity at law. Just by virtue of being a party to that, the landowner would be involved in that activity. In terms of liability, with a partnership, you have joint and several liability. So if something went wrong with the developer trust, then the landowners could be called on to satisfy that liability, which is not great from an asset protection perspective. And then finally, it would totally cancel out the CGT benefit of entering into the joint venture. That's because, again, the partnership would be assessed on its own for the proceeds. You wouldn't have part of it going to the landowner as capital and part of it going to the developer as income. It would all be treated as income, and so there wouldn't be any ability to apply the 50% CGT discount. So in drafting the joint venture agreement, we really want to ensure that it can't be construed as a partnership.
Okay, before you move on, a couple of questions here. One in relation, an easy one, I think, in relation to what you're discussing. Can the developer be a related party to the landowner?
Yes, it can.
Yeah, okay. The others I'll probably leave to the end for now, so just to give you the chance to get through the slides.
Okay. And so under the joint venture agreement, we would set out what the roles of each party entail. So the landowner, we want to be a passive party. All we want the landowner to do is to continue to hold the land, defend the title to the land, and of course, we'll need to allow the developer access to the property to be able to subdivide and develop the property on that land. The landowner will need to sign off on the applications that go off to council. They will, however, be prepared by the developer itself. And then finally, the landowner will need to execute the transfers on settlement, because keeping in mind that we're not doing a sale from the landowner to the developer, it will be a sale from the landowner to the ultimate purchaser. So you will need to sign off on those transfers. But ultimately, the landowner should be passive in the joint venture, and it shouldn't have any control over the development decisions. On the flip side, the developer should have a lot of control over the development activities. So it will be responsible for preparing the DAs, obtaining the council approval. It will be responsible for overseeing any subdivision and making sure that they have the right contractors and the construction resources. The developer will be responsible for obtaining finance to make sure that they can fund the project, and just generally overseeing the project as it is. And then finally, the developer will also be responsible for marketing the developed lots and finding a purchaser. So as you can see, there's a big difference between what the developer is responsible for and what the landowner is responsible for. And if that's all implemented properly and each of the parties stick to their designated roles, what should happen is that the landowners should not be treated as property developers. Their duties should be passive only, and so any receipts that the landowners receive should be treated as the mere realisation of a capital asset and treated on capital account. On the flip side, the landowner will more than likely be seen to be carrying on a business or at least conducting a profit-making undertaking. And so from their perspective, it will be treated as ordinary income. But the point is to maximise the capital component that's received by the landowner and to enable them to apply the 50% discount. So benefit of that is half of the tax bill gets eliminated in their hands by applying that discount. And then, of course, because we're not transferring the property from the landowner to the developer, we're not incurring that additional stamp duty cost. So just going back to our objectives, how can the joint venture agreement tick off on all the objectives that our client is looking to achieve? Well, it will limit the liability of the landowner by ensuring that their role in the development is purely passive. All the liability should be in the hands of the developer trust. And then we maximise the CGT concessions by ensuring that whatever's received by the landowner is treated as capital and that the CGT discount can be applied to that amount. And then in terms of flexibility with the profit, whatever is received by the development trust, that will be in a trust environment. There should be a range of beneficiaries of that trust. And so the trustee can then split that income between a number of those beneficiaries for tax flexibility purposes. Just in terms of GST, as I mentioned before, joint venturers will be subject to GST if 1, they're carrying on an enterprise, 2, they make a taxable supply for consideration, and 3, if they're registered or required to be registered. As I mentioned, it's a very wide definition of an enterprise, and so the safer view would be to say that both the landowner and the developer are carrying on an enterprise. So we would recommend that both parties register for GST. Okay, so just to summarise today's webinar, obviously it's quite a controversial issue as to whether these proceeds should be treated as income or capital, and the Commissioner will try to treat the proceeds as income because it results in more tax in his pocket. But to get around that, we would recommend using an unincorporated joint venture because that will, for the landowner, it will limit their risk and it will also retain the capital nature of their receipts. But also from the developer's perspective, it will give them flexibility as to the distribution of those profits. Who can benefit? Basically anybody who's looking to commence a property development undertaking. It really can develop rural landowners, urban landowners, it doesn't really matter. It's a very useful structure that anybody can implement. So I'll probably hand back to you, Adrian, for those questions.
Sure thing, Kate. And there's quite a few, and I think as we've seen in terms of the polls that you ran and the differences in answers that came through, it is a complex area. And I'll make the comment before I ask those questions a little bit later. Obviously, we're just going on basis of what's been typed into the screen. And normally you would be having a much longer discussion, finding out all of the relevant circumstances before you cast your judgment. So bear that in mind when Kate casts her judgment. Before we do, though, just for those that have to go, we will get through all the questions, but I also recognise we're getting close to the end of the scheduled time. So just a reminder, at the end of the presentation, you will get a feedback email. We take all feedback on board. In fact, this topic today was from a request from our last webinar, from the feedback being completed in that. So a very short survey. Effectively, what did you think of the content, the presenters, any general comments, and what do you any other topics you'd like to be seen covered? Obviously, we take that on board. As I said, this topic today is from a request from last month. So also attached to that feedback email will be the slides if you didn't get a chance to download them, as mentioned. This webinar will also be uploaded to YouTube probably a little bit later today, if not tomorrow, and it will be able to be accessed via our website, or if you follow the Cleary Hall YouTube account, you can access it via that. So Kate, some questions for you. An individual taxpayer purchased land with an existing dwelling, rented it out for 3 months, knocked down, subdivided, and rebuilt 2 houses. The taxpayer keeps both of the houses as rental properties for a year. When the properties sell, should it be considered as capital or revenue?
I think that a decent argument could be made that it's just the realisation of a capital asset, certainly not the carrying on of a business. The ATO may try to argue that it's a profit-making undertaking, but I think it could be construed as capital.
An individual taxpayer purchased property for investment rental purpose for 15 years. They developed 2 new properties. One was sold, the other one was rented. One that was sold, do you think that's capital or revenue?
Yeah, well, it's really a question of are they simply just realising that to the best advantage of the land? There's not a great deal of facts in this one. I think it probably could also be capital.
Yeah, I think the main factor in their favour is that they've held it for 15 years.
Yeah, yeah, that certainly helps.
Yeah, so you can't, the normal sort of thing that the ATO look at is, you buy, put in your DA and do it straight away. That's not the case in this. More, I guess, general deductions. What about an individual who spends money on developing land in a foreign country with a view to renting out multiple units? Can they be considered a business and deduct the expenses of development against other income?
Sorry, I'm just trying to find the question.
While you're finding that one, I'll answer one of these. Self-managed super fund invests in property development with a related party. Joint venture agreement, can related party issues be circumvented? I mean, technically, yes. If it's properly drawn up, a joint venture agreement won't be an investment in a related party. I say technically, yes. Practically, you're going to have issues with the auditor at the end of the day, because they're very likely going to take a conservative view that it's either an in-house asset or a scheme to circumvent the in-house asset rules. So as I said, technically, yes. Practically, probably not going to help you too much. You're right for that other one again, Kat?
Yeah, I'm not sure what you think, Adrian, but I think they probably could deduct those expenses and treat that one as a business.
Yeah, I think it's, as I said before we started, these will often ask a lot more questions, but it's probably also going to be, predominantly it's going to be a question of scale, isn't it, in terms of what they're actually doing and whether they are themselves carrying on the business. The offshore land, is that held by them or something else? We've got to go back to the core questions on that. It's a good question. You'd want to get a lot more detail before you went one way or the other. I have a client who has done property developments in another entity in the past and is now building their new family home with their current PPR to be sold. Will this raise an issue?
I suppose it will depend on the history and how many property developments they have conducted in the past. If it's several, then the ATO could consider that to be a property development business because there is that repetition and regularity. But if they've perhaps only done one property development before or two, then I think it could still be a capital transaction.
In relation to the JV, double barrel question, what size of project should the JV be set up, and can the landowner fund the project?
It can be done for as small or as large a project as you want. Even a small project, there's going to be a fair amount of money invested in it, and so it's good to have that protection there for the landowner. So even a small project, I think the JV would still be suitable. And the landowner, I think it could make a loan to the developer entity and get that money back upon sale.
Yeah, I agree with that. Has the concept of an unincorporated JV between related parties been tested in the courts as to whether it's capital or ordinary income?
I'm not sure off the top of my head. I'm not sure if you've got any cases in mind.
No, I can think of some audits that have come about which have ended in the favour of the taxpayer, but I can't think of any court cases that come to mind either. Question, all purchases of a property would initially be made for profit making. Yeah, I agree with that comment. You don't buy a property usually to hope it goes down in value. Can you please clarify how this would ever be considered capital? I guess, thanks, Tim, for that question. As I said relatively glibly, you don't buy property for it hoping it goes down. Same with any other capital asset. Comes to your back to the overall intention though, because as we know, you can have split intentions, so to speak. But if the dominant intention in acquiring the asset is for capital growth, retention and capital growth, then it's going to be capital rather than revenue. Because if you extrapolate it to things not just real property, you don't, to the absence of things like cars and consumables, you don't buy things on the hope that they go down in value.
But I think there's also a difference between intending to make a profit and wanting that to be capital appreciation as well.
Yeah. With Emmy's question in relation to developing a property on land held for 15 years, would the ATO argue that the purpose had changed and treat the development on revenue account?
Sorry, I'm just going back to Emmy's question.
I'll jump in then. Thanks, Janine, for that. The short answer, yes, potentially, but it's going to relate to what the scale of the development is. So to give you an example, without mentioning any names, of course, client, large-scale farming land holding, entered into a development with a related party for a very large development. We're talking hundreds and hundreds of blocks. It's very difficult in that circumstance to make the argument that their intention hadn't changed in relation to a profit-making intention at that time that they decided to develop the land holding. In the scenario where I think it was from memory, Emmy's question was about a duplex, more difficult to say that your intention has changed and it's not the realisation of a capital asset, but it is an area of risk. And obviously, in terms of this area, as we mentioned before, complex and advice is needed. I can't see any others. Questions that have come through. Thank you, Kate, for your comprehensive presentation today. And as we've seen from the questions, some curly questions out there. It's not an easy area. I'm sure you've got plenty of clients who do this sort of thing and ask you these sorts of questions. If you ever need help with them, obviously we're more than happy to help. Thank you again, and good afternoon.
Thank you.